The rule of 40 is about revenue growth and profitability margins, but it really comes down to I think the key components are GRR, NRR, and ARR. If you're growing your ARR at 40%, retaining it at above 90%, you're almost at the rule of 40. And that means you're almost in the flywheel type of area in terms of startup growth. And investors will come and you'll get a big exit. If you're struggling at any three of those pillars, NRR, GRR, or ARR.
What are those three acronyms, Carney?
ARR is annual recurring revenue. GRR is gross recurring revenue. So what that takes into or gross retention revenue, what that takes into consideration is how many, what was the ARR a year ago to the ARR today, but it doesn't take into account expansions. So it just looks and says, are these people still here? And then NRR takes into account expansions. So are your current client base are they expanding? So the way I look at it is, what's your current annual revenue? Are they renewing or retaining? Are you able to retain them at a good clip? And hopefully, are they expanding? So if your NRR is, 80%, but your GRR is 90% and your ARR is growing at 20%, what that's really saying is you're going up, but over the long haul, your clients are retracting. They might be staying with you, but they're not staying with you at the same pace. So you need all of those to be higher.
So is rule of 40, is that a new thing, or is that just something
No,
new?
that's always been there.
It's always been there.
I haven't called it the rule of 40, but that's really,
I know rule of 72.
The rule of 72 is what we are used to, but the rule of 40 is purely, like, I think those are the three driving components of the rule of 40. It really comes down to how can you get to, a profitable EBITDA. And the only way you can do that is by acquiring your clients and expanding on them at a healthy clip.